Hi.
Hey, Vanessa, getting ready to get started. Probably, I'm going to give everybody maybe about 2 minutes just to see if anybody else is going to hop on, and then we're going to go ahead and get started. How are you
Okay.
doing today?
I'm good. I'm good. How are you?
Wonderful, wonderful. Are you
Okay.
ready to
Seeing
talk
you.
about these exciting taxes?
Yeah, girl.
Look, oh my goodness. Oh, but
All
yeah,
right. See you in a few.
see you in a few. All right, we are going to go ahead and get started. I'm going to turn this camera on here so y'all can see me in some light, because this is not going to be a boring training. I'm going to try to make this fun because taxes can be draining and boring. So what I'm hoping is that there'll be some more people to jump on the call. I know I tried to um, highlight it a lot on Facebook, especially about 30 minutes ago, to grab
Hmm.
some people's attention. So I hope they're not thinking that it's live on Facebook, because I did not plan on casting this one live. Actually, I wanted people to hop into the Google Meet room in case they had questions about their taxes and different things like that. So we are only in this session here today, but I am recording this, so it'll be available on my website if anybody wants to go back and access the training at any time. But welcome to Business Tax Essentials. I'm glad you're here. So whether you're here live in the room or you're going to be watching this replay, this particular training tonight is sponsored by Southeastern Community College. It's located in Whiteville, North Carolina. It's one of my amazing partners through Small Business Centers of North Carolina. And what I do is contract with small business centers to teach entrepreneurship courses like this to make sure that our small businesses within our communities are up to date, up to speed with what's happening in the business climate, and that you're able to rock and roll, continue to grow, continue to earn, continue to learn as your business grows. So we want to take you along that path. So tonight's training is all about business essentials. I'm Biz Coach C, been a business consultant for 12 years this year. So excited about many opportunities that have come, the opportunities that I've gotten a chance to take advantage of that are now part of my past. Great and happy to be here with you, teaching you these great things about business. So if you ever need to find me, you can go on my website at cellismgmt.com to access more information about me and learn more about what we're doing here at C. Ellis Management to help businesses thrive. You can also follow me on major social media outlets at cellismgmt.com. But if you've ever taken any of my trainings, my courses, usually if I'm not trying to fly through them, you will find out very quickly that I like to be interactive. So feel free to ask questions throughout this, especially about business taxes, because I want to keep y'all up to speed with what's going on as far as the tax credits you can claim this year, what write-offs you can claim for your small business this year. So let's get into it. There's going to be some foundational principles that I'm going to teach you tonight, but then I'm going to also make a right turn and give you a list of actual tax credits that you can claim, possibly check with your accountant to make sure that you qualify for these. You just got to make sure you qualify for them, but I'm gonna give you tons of them tonight that you can take back and say, ask those people questions and say, hey, I heard a girl online say that there was this lady online talking about I could claim this tax credit if I qualify for it. So just be prepared to maybe jot a few things down tonight because I'm going to give you that list. Open to questions. I know business taxes is not a very sexy topic to discuss, but we're going to make it fun tonight. So I want to help you save money, have less stress, and keep the IRS off your back. That's our goal tonight, to be fun and informative, but to also let this be a game-changing thing for your business. If you continue to follow me, most of these trainings you do, you see that it's for entrepreneurs, small business owners, business professionals, people in C-suite management positions, and other types of managers, operations, or what have you. So this is all about startup essentials, and let's look at business taxes. Why does it matter anyway? Well, we all know Uncle Sam is on our backs, and if you watched Kendrick Lamar's halftime show the other night, Samuel L. Jackson made it plain for all of us that Uncle Sam is watching, and Uncle Sam is taking note, and he knows what's going on, and there's no lie about that, right? So why does business taxes matter? Why are you going to have to pay them? Because whether you're side hustling, whether you're making your business expand, or if you're already running that empire, taxes are just something that, unless you find the loopholes and you find the write-offs and you find the tax credits, those are the only ways you're going to be able to avoid paying them, right? And so that's what I'm going to show you tonight. I'm going to give you some strategies to help put money back in your pocket, so you can keep it. So before we get started, you probably feel like this about taxes. And we all feel like this burnt out Barbie, especially when we start trying to put all of our minds and our notes together. You're trying to track what you're doing throughout the year, which you definitely got to do. But after tonight's session, we're going to cover 6 main points. So we're going to talk about your business structure and your tax implications for your business structure. We're going to talk about those credits and deductions that you can claim. Since you're self-employed, if you are a business owner yourself, we're going to talk about those self-employment taxes. If you got employees, we want to talk about payroll taxes too. If you're selling tangible products, then we need to talk about sales tax, sales use and sales tax and sales use, and remitting that to your state and staying in compliance within your state. I've got North Carolina here because that's where I'm located. And the college that's sponsoring this free training tonight, that's also where it's located. But this is going to be a general practice for most states. So even if you're in another state, don't feel like this doesn't apply to you, because I promise you, through your Department of Revenue, it's going to apply to you. We're going to talk about record keeping and why it's important for you to track, how to track and avoid the red flags from tracking. And we'll talk about finally some tax planning and strategies for growth for your business. So by the time this is all said and done, I don't want you looking like a burnt out Barbie anymore. I want you to be looking like this cat who is totally unbothered. And I want you to be at this level, somewhere sipping your latte, and the world can be on fire everywhere. Everybody else's tax world, but yours is going to be sipping lattes on the beach. All right. So I already introduced myself, and Usually I'm teaching this class live. So I like for people to introduce themselves. But if you don't mind, I want to get y'all. When I say I usually teach this live, I usually teach this in person. So I usually have a classroom full of people and we do the middle school thing where we introduce ourselves and laugh a little bit. But if you don't mind, feel free to hop off. We're not live on Facebook or anything. This is definitely just in Google Meet. I'm not sharing this on Facebook Live. So if you want to hop off of mute and introduce yourself and say hi and start mingling in the comments a little bit. If you got a page that you want somebody to, you want to promote your business, you can do that here. If you want to share your page links in the comments, you can do that. I'll be happy to go follow and support your page. And I'm sure other people here will. But do y'all want to hop off mute and introduce yourselves tonight and let us know who's on?
I will. You know, I'm always ready to talk.
Let's get it, Vanessa.
Okay. Well, hello, everyone. I am an avid student of Coach C here. I am a retired educator and now a small business owner. And my products that I've been doing were custom stationery, apparel, and gifts and accessories. I'm moving more towards the digital realm, and I've also started teaching Canva, the Canva platform, to beginners. So my Facebook page, my business page is Pastels, Prints, and Papers by Sowell Design Inc. I would love for you to come and join me there. I also have a Facebook group, but once you come to the page, you can learn more about that there. And that's kind of it. I'm really, really hoping to learn something because I slept on some things last year in my taxes, and I'm determined not to do that this year.
Awesome. Thank you, Vanessa, for introducing yourself. I'm glad that you joined us tonight. And yes, ma'am, hopefully you can pick up some gold nuggets that are going to help you have a much less stressful year this year when it comes to business taxes. It's like practice makes progress, right? The more we learn, the more we put it into practice, the better we get with it. So thank you so much. Anybody else on the call want to introduce themselves? And don't forget to drop your links in the comments if you want us to go follow your pages and support online.
Well, hi, my name is Taria Bethel. I have a licensed family home daycare, and I also have a drop-in daycare. I offer second and third shift childcare services, and also I do drop-ins.
Nice. Thank you for joining us today, Taria. Taria, you are like a superhero. Where were you 20 years ago when I had my babies? I needed that second and third shift drop off of daycare. Kudos to you. And thank you so much for introducing yourself tonight and for joining the call. Thank you. Anybody else? Before we hop on to the next part. All right. Then we're going to keep it moving. Well, thank you so much. It is so great to have both of you ladies here and everyone that's on the call. So we appreciate you all so much. And I promise this is going to be a great use of your time. So let's get started. Business structure and tax implications. What do we mean by that? So when we first start talking about taxes, we start looking like this beautifully designed horse on the end. And then when we start actually tracking and putting the paperwork together, we start looking like this six figure with a broken leg on the front. And so we don't want that. What we need is a full and complete picture. And in order to do that, it starts with a solid foundation. So if you already have an established business, which I'm hearing that the majority of people on tonight's call already have an established business, or if you're watching this replay, here's what it looks like to have a business structure. If you do not have a business yet, then you definitely want to take this to heart. Those of you who are getting ready to file, this is going to help you understand what to expect according to the legal form of business that you selected, or an interchangeable term that we use is your business structure. So here we go. If you have a sole proprietorship, the way you pay taxes is your income is taxed as personal income, and you're going to be using your social security number to file those taxes, so it goes on your personal tax report. Self-employment tax does apply because you're an entrepreneur, you're going to be self-employed. So you will have self-employment taxes to pay. The benefits to being a sole proprietorship is it's easy to start this. You usually start it with your local government at your register of deeds office. The drawbacks to this is there's no legal separation and it has a high tax burden on it. So if you get into any kind of litigation trouble, this does not separate. Sole proprietorships don't separate your business from your personal assets. So that's usually what most people try to steer away from when they file the next one, which is an LLC. Now, how do taxes look with an LLC? It's still income tax as personal income by default. So that means you're going to put it on your personal taxes the same way the same way that you file your taxes if you were a sole proprietorship. You just file what we call a Schedule C, a form Schedule C, along with your personal tax report, and it reports your business income. But then at the end of the report, it counts all of that income together, and that's what you pay taxes on. But what you can do is, if you haven't founded your business yet, and when you go LLC, you can get a tax ID number. When you get that tax ID number, the federal government is going to ask you whether you want to be a C Corp or an S Corporation. You don't have to choose either, but just know that if you do select S Corporation, and we're going to talk about that in a second and why that may be beneficial if you plan on making more money in your business. If you select S Corp for taxation, then you're going to file that LC completely separate from your personal taxes. The pros or the benefits to having an LLC is it definitely gives you that liability protection that you hear everybody talking about, but the tax options are much more flexible here. So you give yourself a leg up when you choose this one. And of course, a drawback to it is when you have to pay self-employment tax with with the others too. So that's going to be a given. All right. That's an LLC single member, which means you're the only one that's on the paperwork for that LLC. Single member owned LLC. If you do a multi-member LLC, it's going to be using what we call pass-through taxation, where that tax responsibility is split, and that requires you to have an operating agreement. So what all of that means is that there are more people involved, and with the ownership, all of those taxes are split between the owners. That responsibility is depending on how you designate that within your operating agreement. So if it's just more than you running your LLC, you need to sit down and have a discussion with those other people that are involved with your LLC as members, which means you could have them as managers. They can be officers within the business in whatever capacity. It just means that they have some of that ownership stake within that LLC as multiple members. And so you are required to file out another form. You don't file this particular form anywhere, but you do create this form or have someone write it for you. I've written operating agreements for multi-member and single member LLCs. All that form or paperwork is just an agreement or contract, if you will, drawn up by someone. It can be drawn up by the business owner, consultant, whoever, but all it highlights is here are the people who are a part of my organization. Here is the ownership percentage that each person has. Here's the responsibilities that each person carries out. So it's literally a contract designating who's going to do what and what percentage or what weight of responsibility each one of those individuals is going to carry. So I hope I explained that well enough. Y'all give me a thumbs up if you're good, or give me something else. Give me a thumbs down or a surprise face or a sad face, something if you need to know something else about multi-member LLCs. We're good? All right. All right. Don't forget now, y'all got to talk back to me tonight. Make sure you're good. Okay. So I'm seeing thumbs up. So we're good. We're going to keep going. If you are an S Corp, you want to start looking at S Corps or even thinking about becoming an S Corp or starting an S Corp if your business is making over $50,000 a year, because that is going to help you save more in taxes. So an S Corp or that C Corp, like I was telling you, is you don't directly file S Corp or C Corp with your Secretary of State office like you would file the LLC, PLLC, and things like that. The S Corp and C Corp designations are selected when you're getting your EIN from the IRS. That's when you do that. There's a specific form that you file with the IRS to let them know that you're going to be designating your company as one of these two types. Now, the S Corp, you get to avoid self-employment tax, on profits with pass-through taxation. Again, there's a lower tax burden and business credibility. So S corps have a lot of federal designation, and credibility is something that the federal government recognizes. When you're LLC, you still are state and federally recognized, but a corporation carries more weight federally. And there are stricter IRS rules, and there are also salary requirements here. But just know that if you think your business is going to be making more than 50K a year plus, and there may be a couple of additional factors that you may want to talk to your personal accountant about to get down in the nitty gritty about your personal situation, to say, here, I think I may need to file S corp because I think I can save some on taxes after you do a little bit of research. All right. C corps. C corps, you definitely, as a small business, want to kind of steer away from. If you do not plan on making your business public, selling shares of stock, and having given people corporate ownership in this organization, I would strongly advise you to avoid becoming a C corp unless there's just some type of personal situation that you have where there's monies involved that you're going to be pouring into the business that I don't know about in general, but I can tell you typically in general, you want to stay away from C corps if you are a small business. C corps, they pay taxes totally separately, but as you can see, the federal rate on C corps is 21%. And we're going to talk about tax brackets in just a minute. And I'm going to show you where the majority of small businesses fall within a tax bracket, and where we get to this huge break-in taxes to where we go from paying like a 12% tax rate until we start making enough income till we get bumped up to like a 21% tax rate. And that's a huge jump. That's almost a 10% jump in taxes that you're going to have to pay back. And that's not just on one thing. There's double taxation involved with corporate organizations, with C corps, no self-employment tax. So there's kind of limited growth potential, but C corps you're going to have shareholders, you're going to be public. You're going to be preparing yourself to sell stock in your organization. Now, if you are planning to operate on that level, then you definitely want to look forward to that, because it still has its advantages, but the major disadvantage there, and I've seen small businesses do it, not on my advice, but on the advice of others, because anybody that has talked to me about doing that, they will tell you that unless you're probably making about 250K or more a year, and even sometimes with that, depending on your situation, I'm going to be like, don't go C corp. We're not going to do that. So just let it be a red flag in your mind about that. Here's some personal recommendations that I want to give you, right? If you're a solo entrepreneur making more than 50K a year, again, you may want to think about going S corp. Another benefit to going S corp is the fact that and you can also do this with other LLCs, but your S corp can own other organizations. So if you are what we call a serial entrepreneur and you're going to be opening multiple businesses, then you can use that S corp as your parent company or your umbrella company, holding company, if you will, that actually owns the rest of your business. So usually when you see a family owning an enterprise, that's usually an S corp. And the other organizations that are operating underneath that S corp are their subsidiaries is what we call them, or they're all the businesses that their family owns, right? And that's where that pass-through taxation goes to. It goes through the S corp. So it's a really smart thing to do. If you're just starting, just remember an LLC is great because it protects you against that liability in court, and it's a very flexible business legal form. If you plan on getting investors and going public, then a C corp may be best. Those are my personal recommendations for you. So now, what 5 areas do you usually have to worry about paying taxes in as a small business? This is the nitty gritty right here. It's usually income taxes, payroll taxes, sales tax, property tax, and excise tax. Income taxes is going to be income that's income tax is going to be based off of your profits. So whatever profit you're making, that's what you're going to pay income taxes on. Payroll taxes are for businesses that have employees. You are required to withhold Social Security and Medicare payments from your employees' wages, so we have to do that. As employers, you are going to be paying that, right? Sales tax. Businesses may collect and remit sales tax on eligible goods and services sold to consumers. So if you remember in the beginning when we started, I told you that Sales and use tax are going to be remitted to your state if you're selling tangible products and services. Check with your state's Department of Revenue website. In North Carolina, what you have to do, and with most other states, you're going to have to do the same thing. You're going to apply for sales and use tax certificate, and it's usually on the Department of Revenue website. So if you're selling these products, tangible products, anything that you can put your hands on, clothes, glasses, shoes, wigs, whatever it is, if you're selling something that people can physically touch, then you're responsible for remitting sales and use tax to your state. Now, in the state of North Carolina, the deadline is quarterly, but I advise my clients to pay that monthly because it can add up really quickly. But in North Carolina especially, you're required to pay that every quarter, at the end of every quarter, and there are deadlines for that. Property tax, if your business owns property, just like you would pay house taxes or land taxes, if your business owns property, then your business is responsible for paying that property tax. You don't have to worry about excise tax usually unless you're somebody who's running some type of bodega, corner store, mom and pop store, because it is taxes on alcohol, tobacco, and gasoline, right? So those are the ones that you want to worry about there. So if we looked at all of this section 1 and kind of sum it up into what we talked about, I want you to remember that business tax liability is a crucial aspect of your financial management in your business. So comply with tax laws. It's going to keep you out of off of Uncle Sam's bad side, right? And keep you away from those legal consequences. But anytime you pay taxes, it's influenced by the same things. It's influenced by how well you plan and prepare, the deductions or write-offs that you claim, any tax credits you can qualify for and claim, and changes to any tax regulations. One of the things that you always have to look out for is when an administration changes in the White House, because that means that the tax regulations could very well possibly be changing with what small businesses are able to claim, how much we can claim as deductions, what credits are available to us. So just be sure to watch closely any type of administrative changes coming down from White House legislation and the new administration. That's very important for you to know and to keep an eye out for. If you're following me on social media, when I come across things like these, I usually post it on my pages. So it's like red flags out here or green flags to all of my small business owners. So if you follow me, you'll see a lot of this stuff. All right, businesses often work with accountants or tax professionals to ensure that you have accurate calculations. TurboTax is great, but don't run away from the fact that if you are not an accountant, that you do actually need to be talking to a tax advisor. And it is well worth the money spent, right? Prepare yourself to make the investment to at least sit down and have a conversation. If you don't have an accountant filing, then schedule an appointment with one and invest in that consultation if you have to, because it's going to be very helpful to you. All right, I'm typing my website in here for y'all, so I'll have it for later. And my handle is, if you want to follow me on any social media outlets. Filing deadlines. Deadline for you to file is April 15th of every year. All right. If you are not ready by April the 15th, do not rush and get things wrong, because you can go on the IRS website and you can apply for an extension on your tax filing. And usually they will approve it right there on the spot. It's not a difficult thing to do. You don't pay anything for this. You are literally just going in there, confirming your information and requesting that you get an extension, and you give them a reason. If you are just unprepared to file at the time, you need more time to get your money together to pay the taxes, express to them what that concern is. If it's approved, which most of them usually are, factors of why it may not get approved is because maybe you owe back taxes, or there's something else that causes red flags to tell the IRS, well, hey, this person needs to go ahead and file. It's rare. I don't have many people often that come to me and say, hey, I was denied for my extension request. So if you don't have it together, go on irs.gov and in the search bar, click for taxes, extension on tax filing, and you will get to this application. If it's approved, you don't have to file until October 15th. So you give yourself 6 more months to work and to get it together. All right. Now, I got write-offs and stuff for y'all. And don't forget, that if you have any questions at any time, drop them in the comments or raise your hand or something so I'll know. And you can feel free to come off mute and ask the questions if you have them. So tax credits and write-offs is absolutely the things that we love. Yes. What's the difference between the two? Because they are different. Credits and deductions aren't the same. What a tax deduction is going to do is it's going to reduce how much of your business income is subject to taxes by potentially putting you in a lower tax bracket, right? And you get to write off a percentage of a tax deduction. A tax credit is a little bit different. It's much more straightforward because it's dollar for dollar match for your reduction. So if you have $500 in tax deductions that you want to write off, but you're in a 20% tax bracket, you're only going to be able to write off 20% of that 500 of those tax deductions. Versus if you find a tax credit for $500, then you get your taxable income reduced by $500 and not just 20%. So that's the difference between how they work. Y'all got me there? Let me know. Give me a thumbs up. Give me something. Let me know you're good with that. All right. In the U.S., tax credits offset a company's financial obligation to the state or federal government. Right now, we're focusing on tax credits. So I'm going to drill you in just a little bit more to make sure you understand, because I didn't see any thumbs up, so y'all scared me a little bit. All right. Tax credits of any sort are going to reduce your taxes, again, on a dollar for dollar basis. Now, what are tax credits? Tax credits are things that the government gives you, or incentives that the government gives you when you are helping with economic disadvantages, you're improving environmental aspects. So think about things like there's tax credits for electric vehicles, there's tax credits for energy efficiency products. Those are the type of things that the government promotes. They give us incentives when we are decreasing our carbon footprint and we are more socioeconomically aware that we may be harming our environment in some way. That's where credits come from. And they are more lucrative than your tax deductions with that dollar for dollar match. Here's an example. So if we look at the amounts here on the screen, and I wanted to make sure y'all could actually see this. I didn't know if I needed to try to blow it up a little bit, but y'all let me know if you can't see it or you need it to be bigger or anything, and I'll try to blow it up some. All right. Here's the thing about tax deductions. Here's a great example. So if you have let's say we've got $9,000 that our business has to pay taxes on, and we're going to look at this in tax credits versus deductions. So let's say we got $9,000 that we got to pay taxes on right now. That's our taxable income. If we look at a tax credit, let's say we find enough tax credits, we bought that electric vehicle, and that vehicle costs $5,000, or it costs $10,000, and we're going to take a tax credit off of $5,000. The vehicle costs $10,000, but the tax credit says that you can take $5,000 off as a tax credit if you bought an electric vehicle. So let's say we did that. We got the entire $5,000 that we're going to claim as a tax credit. So now we're going to reduce our taxable income by $5,000. So that's taken away from our $9,000. So that means that we're only paying $4,000. We're only paying taxes on $4,000 versus taxes on $9,000. All right. If we compare that with looking at a tax deduction, that same $9,000 we start with, your business is in that 20% tax bracket, and say we're going to claim that car just as a deduction instead of taking a tax credit for the electric vehicle. We're going to say, well, I bought the car, so let me just claim it as a deduction, and I'll use it as a write-off. Well, since you're in that 20% tax bracket, you can only take 20% of that $5,000 deduction that you're claiming. So that means you're only able to reduce your taxable income by $1,000. So in this instance, with the deduction, you started out with $9,000 that you had to pay. And by the time you wrote off that car, the car was $5,000, but you only get to claim 20% of it because that's the tax bracket you're in. So now we're looking at $9,000 minus just $1,000. And so with this scenario, you would have to pay taxes on $8,000. So y'all see the difference there? because that the tax credit took 50% more off on what you're gonna have to pay taxes on. So just think
How
about
does it?
I'm
Sorry,
sorry.
sorry to interrupt.
Sure.
Sorry to interrupt. I was wondering, how does it work if you're writing it off like by the miles? Like someone's talking about how they're pretty generous on the mileage. Like for example, 50 cents per mile. Does it still like a percentage of that amount?
Yes, it is. When you're and think about it, that's a great question. Great question. So if you're thinking about it like that, you can definitely take the mileage. But again, mileage is not a tax credit. Mileage is going to be a write-off. So it's going to be considered like a deduction. So you're only going to be able to claim a percentage of that mileage as well. That's a great question.
Thank you.
You're welcome. Thank you for asking. And let me tell you all this too. You can claim credits and deductions on your taxes. You could claim both, but they cannot be in bed together. So it can't be for the same thing. So we can use that as an example because that was good. So say you got a car, right? You're going to claim a tax credit for the electric vehicle you bought or whatever energy efficiency product, whatever. You're going to claim the credit for that. Well, you can't claim tax credit for the vehicle and you can't deduct the mileage or something too. So you can't do both. You have to choose one if it's for the same thing. So you can use all the credits you want. You can use all the deductions that you want, as long as they are not for the same thing that you're claiming on your taxes, for that same property, for that same valuable, that same whatever it is. You cannot claim both of them for the same thing, but you can claim both credits and deductions on your tax. So you can do both, just as long as it's not for the same things. All right. So if we're talking about tax bracket now, here's that jump that I want to show you. So if your business is in the tax bracket where you're only paying about 12% taxes for what you're making according to what your total income is, and if you go over this income that's usually in this second tax bracket, and these may not be the exact figures, but you know what? I will put the exact figures up on my website so people will have them because it's a great thing to know. What's going to happen is once you start leaving this second tax bracket and you go into the third, do you see this big jump right here from 12% to 22%? That's a 10% increase in tax responsibility. And so I know that y'all hear a lot about small businesses that close like within their first 5 to 10 years. A lot of the reason is because of this. One of the reasons is because they can't find enough funding. But there's also an implosion sometimes that happens with small businesses, which means they're making too much money that they can handle. Can you believe that? Like that's actually a thing. Say, I can business coach C, I can actually make more money than I can handle. Well, it's really a matter of proper planning. So this is what I advise my clients to do. For every dollar that you make, put 10% of that dollar into a savings account and hold it for taxes. So you need a separate tax account. It could help you do that management of money better, that tax planning better, so you won't be hit by surprise. And if you are going to be falling into that third tax bracket, then you want to look at saving 20% of every dollar in a separate savings account so you don't get hit with a surprise on the following year. All right. So that's just something for y'all to think about is where right now does my business, what tax bracket do I fall into? So what is the percentage of my tax responsibility? What am I going to have? What bracket do I fall in? And that will also tell you the percentage of deductions that you can write off and claim. All right. When it comes to filing your tax credits are each going to be done on individual forms. There are a ton of these tax credits that you can claim that are on the IRS website. And I want to give you the link real quick, see if I have it here. So if y'all will take this website and write it down, or if you can take your phone, something, scan the QR code. This is on irs.gov. This is where you'll find all of the federal tax credits. Now, these are just federal. There are also state tax credits available for the state that you live in. There are also sometimes local tax credits available for where you live. And so that's the importance of talking to an accountant, because even if it's like an accountant that's online with this major organization, I would just find somebody either local who knows what those local tax credits are that you can claim, or a major organization who really has access to that sort of information, so they can be really upfront and honest with you and give you some real opportunities for you to claim tax credits. So that would be helpful. And just to go back to where we were, so I was telling you that each individual tax credit that you decide to claim, it has its own form that you fill out. And I'm going to show you a list of those in a minute and what the forms actually are. We're going to go through some. And this session is going to be recorded, so I don't really expect you to write down all of these. But if you find something that stands out to you, I want you to jot it down and jot down the form number so you can go back and look at it to see if it's a tax credit that you can claim, because I'm going to run through some with you, at least about 10 I'm going to give you tonight. Here's the thing. If you decide to claim it, you definitely have to qualify for it. But then what you have to do is fill out a form that actually helps you calculate that tax credit and the amount that you can claim for it, which is dollar for dollar. We talked about that. So each tax credit that you claim, you're going to take that form that you filled out for it, and you're going to bring all of those forms together, and you're going to add each individual one on form 3800. And this is the form that actually reports all of your tax credits. Now, if you're having this filed electronically, it's going to work different. It's going to look different, but it may help you as an individual to go online, find these tax forms that correspond with these tax credits, go ahead and start taking a look at it along with the qualifications and how it's going to add up for the dollar amount for you, and put your monies in there. Use the fields for what you've actually spent with these tax credits that you can qualify for and claim. Those totals are going to be put on an IRS form 3800, and that's going to tell the IRS that that's how much you can claim as tax credits, right? So that's what you get. Now, what's a red flag to the IRS with this is if you're taking an excessive or oversized amount of tax credits. So just be very careful with it. Form 3800 is going to kind of look like this. Of course, if you're filing your taxes electronically or someone else is doing it, you're not going to be looking at this. But if you just wanted to have access to it, to see what it looks like, go online and search Form 3800 General Business Credit. This is where your tax credits are filed, and all of the totals from every other credit that you claim is going to go on this form. And when you get to the last question there in section D, that's going to give you the total amount that you can claim in tax credits, which is going to reduce your overall taxable income, like the example we went through earlier. Awesome. All right. Who's eligible for tax credits? There are eligibility thresholds that your business has to meet. So qualification is the number one thing to consider when you're looking for tax credits. Taxable business income, how much income you have that can be taxed is one qualifying factor. Do you have employees for some of these? Some tax credits are dependent upon your location. So don't forget, I told you there are federal, state, and local tax credits that you can claim. Look for all of them, all right? Or have someone to look for them for you. It just depends on where you fall from year to year in these thresholds that determine which ones you qualify for year to year, all right? But I can actually move this slide up in the presentation, honestly, because I already told you guys this. Where do tax credits come from? They come from the government, and it is the government's way of encouraging us as small business owners to take advantage of actions that contribute to economic growth, create jobs, innovate what's happening in our society, coming up with new ideas, anything that helps push public policy goals and things like that. That's what you will see in tax credit examples. And again, here's the list for the federal government's website. For IRS, it's got a full list, like hundreds of tax credits that you can claim. You could go on and read there and see a whole lot of what's going on. So yeah, you are like officially an entrepreneur. Because you are, I want to show you what you can actually claim as taxes. So I'm going to switch claim as tax credits. Let me give you some tax credits to actually look at here. And we're going to go through, yeah, I think maybe I have about 8 to 10 of them. So let me show you guys these. I'm going to share a different screen with you, so bear with me for just a minute. While I'm switching over, don't forget to, if you have any questions, please drop them in the chat. Y'all know I am happy to answer. And I will say again, this is going to be posted on my website after we finish this presentation. So if you have any questions about anything, you'll be able to go back, visit my website, and just fast forward to where in the presentation you're actually looking for. So I hope that's going to be super helpful to y'all, and it'll probably be on my YouTube channel also. All right, so here are about 8 to 10 tax credits that I want to give you. along with the form numbers for filing if you want to figure out how to put these together. Now, don't forget, for each one of these tax credits, you do the form, you fill out that form, you come up with a total amount that you're going to claim, and then every tax credit form that you have is going to go and be compiled on a form 3800 with that total. Here's the first one: Rehabilitation, Energy, and Reforestation Investments Tax Credit. This is Form 3468. You might be eligible for this if your business spent any money on rehabilitating or renovating an old building, doing some reforestation. If you're in a tourism business, this is probably really good for you. Agritourism or ecotourism, or used alternative energy sources like solar or wind power in your business. So that would be you. Rehab, Energy, and Reforestation Investments Tax Credit, Form 3468. This tax credit usually covers 10% of your expenditures and is capped at $10,000 per year. It's a huge tax credit to claim. All right, the next one is the Work Opportunity Tax Credit, which a lot of people have heard about WOTC up until this point. It's filed on Form 5884. And you may qualify for this if you hire employees who face significant barriers to employment. And this can save you up to $6,000 per employee. Next one I'm going to give you is credit for increasing research activities. Now, if I'm going too fast, y'all come off of mute or pop something in the comments and let me know if I need to go back and show you. So, because I'm moving along, I'm reading because I'm going to run out of time after a while. I want us to get through all of this because we still got to talk about write-offs too. But at any time, if you guys want to, if you need me to go back and see, if you need to go back and see anything else, let me know. All right, credit for increasing research activities. This is Form 6765, or you can use Form 8974. So what is this? You can claim this tax credit if you spent any money developing patents, so that intellectual property. If you spent money on trademarks, building new software, working on prototypes for a new product, or any other kind of R&D, then you might qualify for this tax credit. Figuring it out can be tricky. So, of course, getting that advice from a professional tax accountant or a professional accountant and an advisor would be really good for this one. Disabled access tax credit. This is always great. And the ADA will be super happy if you are able to do this. If you've spent any money on making your business more accessible to people with disabilities. So if you've had to put signs in the parking lot, if you've had to do the paint on the pavement, if you've had to add any type of accessibility to your restrooms, certain type of elevators, lifts, anything like that, you can file Form 8826. Let's see. All right. Yeah. Awesome, Lisa. I'll go back to the credit slide again. Was it this one, Lisa? The Rehabilitation, Energy, and Reforestation, or was it another one? Let me know. All right. Gotcha. Good. Yeah, this one is a pretty good one to claim. You can save a lot on this one, depending on how much you spent. And it's a dollar for dollar match. So you're good. You're welcome, Lisa. No problem. All right, folks. We ended up with disability access. Next one is those EVs. So qualified plug-in electric vehicles tax credit. This is also Form 8834. You will notice that a lot of these forms will be the same number. So it's literally, you're going to be using the same form for many of these and just filling it out different times for each one that you're going to claim. So qualified plug-in electric and electric vehicle credit. You may qualify this if your business purchased an electric vehicle and used the qualified plug-in vehicle on or after 2010. So can be electric car or scooter. And that's worth between $2,500 and $7,500, depending on your vehicle's battery capacity. So that is one of the deciding factors in that tax credit. But there is opportunity there. The next one is EZs. So empowerment zones, renewal community employment tax credit. This is Form 8834. So if you hire anyone who lives in a lower income area, you could qualify for this tax credit. So consider that with your employees. How do you find that out? Because a I know this is not like a customer service or a courtesy type coaching training session, but you're supposed to have all of your employees' information when you hire them. You know, their demographic information, their proof of residency, and they're like a valid ID if you have employees. And so you can check that address on the HUD, on the urban housing and urban development on your HUD websites. You can check for them on you can check to see if they're in hub zones. That's something historically underutilized business areas, things like that. If you're typically in those type of zones, they're usually maybe somewhere near low income areas, and so you're able to claim this as a tax credit if you have employees that live in these type of areas. So you can definitely your business can benefit because you're helping to benefit. Again, tax credits are something that the government gives us to improve what's going on socioeconomically around us. So there's a benefit to that. Tax credit for employer Social Security and Medicare taxes paid on certain employee tips. And so if you got employees that have tips or that earn tips, then you want to use Form 8846 because you might qualify for this one if you employ workers in the food and beverage industry and those employees get tips and you pay Social Security and Medicare taxes on their tips. So just think about that. And a lot of people I notice, especially in North Carolina, a lot of the waitresses don't like that their tips are, some organizations will actually, you know, get their tips and say, hey, you got to be taxed on these tips that you earn. All right, this applies to that. New markets tax credit, Form 8874. You could qualify for this if you've invested in an organization that promotes job creation for low income communities. So if you are someone like me, you got a huge, big heart and you're trying to get into your community and do super positive things, and you've got businesses that you're trying to start there, you're hiring employees, then you're opening up markets in your area. And what the U.S. Department of Treasury calls these organizations is community development entities. So if you're a CDE, then you can claim the new markets tax credit if you're going to be promoting job creation in your area. All right, credit for small employer pension plan startup costs. And so I know us as small business owners, we always, always already have issues funding our businesses. And so we aren't thinking about retirement or pension or anything like that. But I do want you to definitely consider it. If you haven't started saving for yourself as a small business owner, do it. Whether you are doing, it's not, and 401k is not your only options, right? There are Roths, there are Roth IRAs along with traditionals. There are SEPs, there are SEPs that you call, like they call them SEPs, SEP accounts that you can do. There are so many options where you can open retirement accounts for yourself, and you get credits for it if you do. So Form 8881 is a credit for small employer pension plan startup costs. And your company has 100 or fewer employees who received at least $5,000 in pay. You haven't had an existing 401k or other retirement plan in the last 3 years. You plan on starting up a pension plan for your employees. Credit is worth $500 or 50% of the startup costs. And you can claim this for 3 years. You cannot claim all of your credits over and over and over, but this one you can claim for the first 3 years, and that's powerful. So that's kind of worth the investment for you to take a look at. All right, you guys, we are almost done. Employer provided child care tax credit. So if you are an employer who provides child care services for your employees, Form 8882, if you pay for your employees' child care expenses, you can receive 25% of those expenses as a tax credit. So that's a huge one there. If your company is incorporated and you're an employee, you could be eligible for the same benefits as your employees. So just think about that. If you are also an employee of your organization, if you're incorporated, that S Corp or that C Corp, you can also be eligible for those same benefits. All right, credit for small employer health insurance premiums. This is Form 8941. If you pay premiums for your employees' healthcare coverage, then you might be eligible for a tax credit of up to 50% of those expenses, provided certain criteria are met. So the qualifications are important here. You got to have fewer, less than 25 full-time employees who pay at least half of their employees' premiums. So they have to be paying into it also, and have average annual wages below $66,000 a year. Additionally, companies must purchase the coverage through the Small Business Health Options Program. So some stipulations there, but you may qualify for it. Family and medical leave, there's also a tax credit for that. That's Form 8994. If you provided paid leave to an employee or family or health-related reasons for at least 2 weeks at a time out of the year, then you can qualify for this tax credit. All right. And of course, I'd already given you the link in the other website. This is the same link that gives you all the tax credits that are listed on the federal government's website. So if you go to the IRS, you're going to see something that looks like this. So you can just scroll through this entire list and basically just kind of glance over it. And you could just see by a lot of the names, like, well, I may qualify for that one. I definitely won't qualify for these, but I would advise you to take a look at that list. Write down the form numbers that you think you qualify for. Go back and look at these. Sit down, read them, and if it's something that you think you would qualify for, get the information together, pull it together, and trust me, claim that tax credit. You're going to be happy that you did. You're going to be very happy that you did. All right. We're going to jump now into the write-offs part, because everybody likes to talk about write-offs too. I just like to start with tax credits because I don't hear enough hype about tax credits. And it could be because a lot of people do not know that certain tax credits exist, or they're afraid to do it, or they may just not have any that pertain to them. But I guarantee you, if you do some digging, you can find at least about 1 or 2 of them that will apply to you where you can take off. But now we're going to talk about the write-offs that people love. And this is going to be like it's going to be like a huge span of them, almost like the tax credits that I showed you. It's going to have several of them. So what can you deduct? The IRS has a stipulation that says you can only deduct what would be considered as ordinary and necessary in your business. Now, I know that sounds big and vague, but think about it like this. I have to drive like an hour and a half from where I live to go teach entrepreneurship classes sometimes. I drive a Chevy Tahoe. I do not need to go get a Rolls Royce to drive to go teach those classes an hour and a half from here. The Tahoe will take me there just fine. And the Tahoe fits in my tax bracket. So for my business. So that's ordinary, that's necessary. If they saw that I was trying to claim that Rolls Royce on my taxes, then that's going to be a huge red flag, because you're going to have this sore thumb of an expense sticking out there that's not going to look ordinary. And once they start doing the research, they're going to find out it definitely wasn't necessary for me to have. So that's just a great example. That means a deduction is anything that's going to help your business make money. So think about it like that. Anything that you spend money on that's going to help your business make more money, then we want to look at claiming that as a deduction in our business. Ordinary and necessary are the 2 highlighted things that I want you to understand here. Because if it's not, then the IRS is going to be looking at you like this. You're not going to want that look from Uncle Sam. So we talked about the percentage that can be taken off and how deductions reduce your taxable income. I'm going to show you another example of how it does that. So we already looked at this one. We looked at the tax credits versus the tax deductions. And we talked about how tax credits are more lucrative, because we see that if you claim the right tax credit, it can take off thousands of dollars from your taxable income. So you're only paying taxes on $4,000 here, versus your deduction only taking off a percentage and leaving you but still paying thousands more of taxes, or at least your taxable income is thousands more that you're going to have to pay on versus the 2. So let's drill it down to looking at specifically how a deduction makes an impact, right? So here we go. Let's say we have an example where we don't have anything to write off versus where we do have something to write off. So say your business has made $600,000. You've got to pay taxes on $600,000, right? We're going to leave that as our taxable income. Let's say we don't have a write-off. So there's nothing to take out, 0 here. So your taxable income is $600,000. Your tax rate is 40%. So you're paying 40% taxes on $600,000. So that's $240,000 in taxes that you're going to owe, right? If you have a tax write-off of $50,000, so let's say we claimed enough deductions and we fell in the tax bracket to where we had at least $50,000 in write-offs that we could claim now. So that brings our taxable income to $550,000. We're in the same tax bracket, so we still got to pay the same tax rate. But now we're only paying 40% taxes on $550,000 because that's what we were able to deduct. So our tax payment is $220,000 instead of $240,000. So we've saved $20,000 in paying taxes just because we found enough in deductions to help us out there. And that's how tax deductions work. And that's why you hear so many, even large corporate organizations, searching, finding, and having down to a science what they're going to claim in tax deductions. And business, the way small business works is, practice makes progress. So continue to do this each year for your business. Track your expenses like you never had before. Have great accounting software, something like QuickBooks to help you categorize that stuff accurately. Balance your books every month. Go through that financial management. I know that this presentation is kind of late in the game because April 15th is the due date. And so we're only like 2 months prior to that. But what you want to be doing is having a great relationship with an accountant or an advisor that you're checking in with throughout the year to say, hey, are you hearing anything about the upcoming tax year? Can you just take a look at my stuff and see how I'm doing? Let me know where this falls, that falls. What do you think I can claim in deductions up to this point? What can I do better? So that relationship matters. Don't wait until January to start talking to your accountant about the taxes that need to be filed in April. Have a consistent and ongoing conversation with them about what's happening in your business. Now, I got to give you a list of some stuff that you can write off because I'm not going to teach you a course and not give you tools that you can go back and apply. I just refuse to do that. It's not the way Coach C works. So here we go. Advertising and promotion. So your marketing, your website, your ads that you're putting on social media, your auto expenses. So we heard a question earlier today. So you can claim that mileage and you can use an actual cost method for that mileage. Parking, tolls when you travel, bank fees, business insurance, business licenses and permits, zoning licenses and permits, things like that. If you've got a brick and mortar place location that you're going to be putting up somewhere, charitable contributions. If you've donated to any organizations, 501c3, make sure you keep those receipts or get a letter of donation from them or sponsorship. You can claim that. Commissions that you pay, cost of goods sold, your materials, labor and inventory, meals, but be careful with the entertainment because that can get kind of sketchy. So just remember ordinary and necessary with that, but you can pay for business meals. All right. Merchant processing fees. That's super important because I guarantee you, if you're accepting credit cards, debit cards for payment, that you're getting some type of merchant processing fees. All right. Payroll expenses, photography, videography, that equipment, anything like that. Professional fees, office expenses, equipment, software, online services, supplies, your rent, salaries and benefits, seller fees, shipping and packaging, education, whether you're going back to school, attending workshops, trainings. I have a series going on right now in my community that's a ticketed event that I'm encouraging entrepreneurs to attend. They are eligible, one, for a grant at the end of the year if they attend 4 out of 6 of these meetings. And what happens is they also get to take what they've paid for my trainings and file that on their taxes as a deduction. So that's really, really good. Taria, yes.
Oh, I was looking for the chat box to ask where, will we have access to those trainings? Is it a link or something?
Yeah, that's good. So you mean the series that I have?
Yes.
I will send it to you. Well, actually, I will tell you what, the series is on Eventbrite and they are local in my area, but I think what I'm going to do is make the rest of them. There are 5 more left. There were 6 throughout the year. We've only had one. So if you attend 4 out of the 6, then you become eligible to receive a grant, $1,000 micro grant that my nonprofit is going to be giving away at the end of the year. I am getting ready to give you a link to my Eventbrite page because all of the other 5 events for the year are going to be listed there. So I'm just getting a link to this right here so I can send it to y'all and drop it in the chat. That's a great question. Thank you for asking. Here we go. All right. I'm going to drop it in the comments here. This is a link to the next session, and they are bi-monthly. They're every other month. So our next one is going to be, and it's always the first Saturday in that month. So our next one is the first Saturday in April, which I believe is going to be on April 5th. And they are 3-hour sessions because we include lunch in that. So they're from 10 to 1. So, but there'll be like a 45-minute to 1 hour break in there to where we won't be really doing much teaching. A lot of that's for networking. So part of that is actually getting together for the networking to help build each other's businesses too. All right, but that's it. I hope that helps. And if you click on my name in there, you can probably get access to follow my entire page, and the rest of the events are listed there. All right, but what else can you claim? And y'all feel free. I'm telling you now, Tari's got it. She's on the money. If y'all got, and the question that was asked earlier too by Mr. Hart. So if y'all got anything, feel free, pop in the chat, raise your hand. I'm here for you. All right, what else can you write off? Write off gifts. The great thing about gifts and the tricky thing about gifts at the same time, and the same thing with uniforms here. So if it's going to be things that are like that are tangible, going to be handed to someone, worn, whatever, you want to make sure that you brand it somehow. So if it carries your brand, then you definitely don't have anything to worry about. It may just be harder for you to prove that you needed a suit for a certain meeting or you needed this for your business. So just be careful. If it's branded, then it's a lot easier to prove. And we only claim what we can prove. So just remember that with gifts, especially, get you some stickers. Just it's something that's simple. You can have stickers with your logo on it and just stick it on something if you're going to give it to someone for a gift. And remember, just ordinary and necessary. All right. Your home internet bill, your home office expenses, interest expenses that you get from the bank and accounts, subcontracting, telephone communications, cell phone, voice over IP, travel, your airfare, that ground transpo, lodging, local transportation, all things that you can claim. Business startup costs, qualified business income, business use of a car. So if your business does not actually own your vehicle, but you are able to track your mileage because you're using your personal vehicle for business purposes, you just have to be able to prove that, but you can claim that as a deduction. We said rent already, and home office, certain amount of square footage in your home office that you can deduct. So think about that. Make sure you got that square footage for your home office if you're using it. You can also rent your house out to your business for at least 2 weeks every year, and your business can pay you for renting your house. So that can be in addition to whatever income or payroll or owner's draw you get from your business. You could actually plan to rent your house out to your business for 2 weeks. And you just have to have solid purposes written down for why you're doing it. But that is something that you can do. Just a plug right there. All right. We said charitable donations, all those paper clips, pens, folders, and stuff you have to buy. Depreciation, whether that's on your vehicle or on your property, you can claim your depreciation. Legal fees, if you're working with somebody like me, a coach or consultant, you can file my fees as a tax deduction. We said advertising and marketing. We already talked about payroll with employee wages and benefits. Said credit card processing fees. Bad debt. If you are in a position to write off some people who have not paid you throughout the year, and this is really specific to service-based businesses, it happens more with service-based businesses because they operate mainly like on invoice and things like that. So if you have a client that maybe has struggled paying you, maybe their full invoice, and you want to keep the relationship, You just want to move on and you know what to do better for them next time. They've got a balance. You could have a win-win situation on your hands because you can make them happy by saying, hey, I'm going to write off this balance that you have left and we're going to start fresh on your account with the next service. We're just going to set things up better for you in the future so you can afford this. Well, it's great for them, but it's also great for you because the amount that you write off, you can actually claim as a tax deduction. So bad debt is something that's real and you can actually use it to benefit your customer, your client, and your business. Business taxes there. Be careful with this one. With business taxes and claiming deductions on previous taxes. Talk with your accountant about that specifically because I cannot give you an individual answer because that's such a personalized thing. All right. Gifts under 25. You can definitely claim gifts over 25. Just remember ordinary and necessary. Insurance, inventory, business phone bill, travel expenses, and retirement plan contributions. And so remember what we discussed before. Your retirement plan contributions, you can claim those as a deduction, or you can claim the tax credit if you're just starting up retirement plans for yourself as an employer and for your employees. So look at which one is going to pay you more there, and that's the one that you claim if it's something new that you're doing. All right, we get ready to round home plate, y'all. And one of the last things I like to talk about is pass-through business. Pass-through business tax deduction law. So most companies are going to be using the pass-through tax law when they're filing their business taxes, which means they're going to be filing all of it together. So usually when you're filing your taxes, you're not going to file for yourself and close that out and pay those. And then you're going to open up a new profile, start plugging in the stuff for your business taxes and pay that separately. Does not usually happen that way. You usually are using what we call pass-through law, which means you're filing everything at once. You're filing any personal income that you have, and you're filing your business income on the same return. Now, just because we're filing that on the same return does not mean we're filing everything on the same forms. So you still will be filing like a 1040 for your personal taxes, but then you're going to be filing a Schedule C for the business taxes. There are going to be deductions and credits for each one of those that you're going to use. You're just going to submit it all together on one return. And that's what that means. So I don't want you to get confused with that, thinking that that means that everything is going to be all together and there's not going to be any separation between what my business has made and what I've made. No, it doesn't mean that. That's still going to be separate according to the forms that are filed, but it is going to be on the same one return. All right. Self-employment taxes and payroll. We all want to get this huge bundle of money like wrapped up pretty in a bowl. But in order to do that, we got to make sure that we're taking care of the responsibilities first. So if we look at what self-employment taxes are like, and we started out today's slides talking about self-employment taxes and those business structures that are responsible for paying them. If you make over $400 as a freelancer or business owner, then you need to pay, and you are going to be responsible for paying SC tax or self-employment tax. And that is 12.4% for Social Security, 2.9% for Medicare. So we're looking at 15.3% total. Quarterly estimated taxes, or QETs as we call them. So if you're expecting to owe $1,000 or more in taxes at the end of the year, then it's great to go ahead and pay your taxes quarterly. Now, this is not the standard for everyone like I have written here, so just check and see. But I will tell you quarterly, if you're in North Carolina, we talked about remitting those sales and use taxes if you have to pay them quarterly. And if you do need to pay those estimated taxes on a quarterly basis, here are your deadlines: April 15th, June 15th, September 15th, and January 15th. Those are when these are due. And you're going to use IRS Form 1040-ES to help you calculate those payments for self-employment taxes. If you are not a tax professional, don't try to jump off this cliff and do all of this stuff yourself. This is a lot, and there's a lot of room for human error when you're doing this, even if you're using a tax system like TurboTax, who asks you a million questions. There's still an opportunity that something can be missed. So if you're not making like a huge amount of money, and say you're making less than $10,000 a year in the business, and you feel like this is something you can manage because you've tracked everything that you're doing well, you understand that there's certain things that you qualify for and not, and you're not stressed out about this money, like there's still opportunity there for you to actually have a lesson that you need to learn and get a slap on the wrist. So just be careful. But I would say if your business is producing more than 10,000 a year, then you definitely need to start looking into how can I make sure I can have someone to help me line this stuff up correctly. All right. Taxes and payroll. So this is if you have employees. You know, we talked about income tax, their Social Security, their Medicare. This is filed on Form 941, and you want to pay those payroll taxes quarterly, right? Software, again, here's some suggestions. I personally, I'm on QuickBooks. It's my absolute favorite. If I had employees that I would be given a W-2 to, then I would use Gusto. And that's just my recommendation. I don't have employees, and but if I did, I would go Gusto because it is a very robust but affordable system for small businesses. And they just have a customer service feature that I actually love. So I've given it a test drive before, and I found out that really for me to optimize that system, I would have to have employees on my roster and be doing W-2s. And if I did, I would definitely go with Gusto. But since it's just me, I find QuickBooks very helpful for me. I was on QuickBooks self-employed, but it was not as in-depth as the QuickBooks Online system. And there's honestly only about a $10 difference per month. What I found that I needed was a balance sheet when I was trying to qualify for certain business grants and business loans. QuickBooks Self-Employed does not offer balance sheets, but it does offer some reports. I think maybe a P&L statement, maybe a profit and loss statement. But what I found out was that QuickBooks Online did actually offer the balance sheet, full set of reports, and you still get the option to categorize, but it is the reconciliation piece that just saved my life, because what I discovered was there was some spending happening in my business that I needed to really get control of. And I had no idea it was there when I was just doing the self-employed package. And it helped me learn how to scale to a 6-figure business quickly. So last year, when I started looking at everything when I was doing and my business had produced 6 figures, like it was easy for me to see where did I make this mistake? Where was this happening? Where was this spending going? That was, this category is too high. I need to break down these expenses by at least about 20-30% to make sure that my business is more profitable in this area. So I would advise you, if you go in QuickBooks, if you're small, maybe start off with the self-employed package. But if you're looking at scaling, then check with QuickBooks Online, because I'm pretty sure you're going to be happy with it. I even added a feature where I could talk to the tax professionals live, and I pay for that monthly too, because I'm actively working on improving that financial management in my business. So that helps me a lot, especially with the reconciliation and all. But that was a pro tip that I gave y'all. That was a sidebar. But if we go back to this pro tip on the screen, if you're paying yourself as an S Corp owner, then you must pay yourself a reasonable salary to avoid IRS penalties. A lot of business owners miss this. So be careful with that. If you do go S Corp, just know that you have to take a salary. The other business types, you don't necessarily have to take a salary. Or what you can do is you can write yourself that check, even if you have not cashed it yet, but you got to write that check. If you want to know what a reasonable salary is for someone in your area for your industry, just go to salary.com and type in the industry, the state that you're in, like a quick job description, and salary.com will give you the low range for pay for salary and benefits, a medium range, and a high range for salary and benefits. So that's where you can find that information. All right, sales tax and compliance. Just know, again, if you're selling those tangible products, then you're going to have to pay your state sales tax. You register for that with your Department of Revenue office for your state. You can do most of this stuff online now. It's not by paper anymore. But when you remit that, you need to remit it at least quarterly, pay it at least quarterly. Try to pay it monthly if you can, and try to make a habit of paying it monthly, it's going to make you feel a lot better about your business. You're going to be able to scale quicker and make better monetary decisions because you'll know where the money's going and you'll know what you're responsible for paying. So your sales tax rate for your state is going to be there. In North Carolina, for me, is 4.75%. Any more North Carolinians on the call today? Where y'all from? Drop in the chat for me what state y'all are in. I may have some special cues for you. Yeah, Lisa. Yeah, that's right. Lisa's like, she didn't consider that 11 minutes ago. Saw that. Yeah, come through New York. Yeah, let me know where you are because I may have some highlights for you. All right. Local rates for your taxes can be anywhere from 6.75 to 7.5%, depending on your county. Local rates can bring it up to that. So yeah, in North Carolina, I think right now in my county, I'm in Columbus County, North Carolina, and we have a 2% tax rate. So I'm paying 6.75% in taxes on my tangible products that I sell. So it just depends on the state and the county. But it's going to be filed on an E500 form in North Carolina. I see you, Omaha, from NYC. I got you. That's awesome. All right. So just consider that. Who needs to collect and remit sales tax? Collect means you're going to be charging your customers or clients for that sales tax, and remitting it means you're going to be paying it to the state that you're in. Oh, I know. I'm sorry. I see you, Lisa. It's sad. So if you're selling physical products, and now be careful because some digital products you actually have to pay sales tax on. So just be sure to research that. I sell digital products on my website, and because it is something that you can actually print off and use and fill out, it's tangible. So I have to collect taxes on my digital products. So, and providing services, most services are tax exempt. So if you are the consultant piece of it, of my business, I do not have to remit sales tax on. There's nothing tangible for folks to walk away with that coaching, this training. You know, if I was charging for this, I couldn't charge you taxes for this thing, even though you could, you know, print the slide deck and everything. It is not a part of the product that I'm providing you. So there are a lot of services that don't. Lawn care businesses are typically ones that also are not going to collect sales tax. Now, if you're a lawn care service and maintenance people that sell bags of mulch, that may be selling other little landscaping things, then that's tangible. See, that's taxable. If it's tangible, it's taxable. Think about that. All right. Registration and compliance. If you're going to do it in North Carolina or any other state, Department of Revenue office. And I think that I have already given y'all most of this information, even the pro tip. So if you sell online and have customers, if you have customers outside of your state, you can check a platform called Nexus that will help you determine if you will owe taxes in another state too. And so that gets kind of tricky, but you can check and see. So if you are selling tangible products or services, you definitely need to be keeping track of where you're selling your products and services. And there may be sales tax that you would owe and some other form for that. But if you check the Nexus site, it will let you know that information. So I hope that I have given y'all like tons of things to think about tonight with your filing your business taxes. And I know that this class is only essentials, and you've gotten full list of tax credits and you've gotten lists of deductions. Right now, before I finish up with this section of penalties, if you have any questions at all, because penalties, you can walk and chew gum at the same time because only brilliant people watch my lives, and only brilliant people take my classes, and only brilliant entrepreneurs take my courses. So you're brilliant people. So I know you can walk and chew gum at the same time. So while you're listening to me talk about these hateful penalties that you could possibly be facing if you don't get these things right, I want you to drop your questions in the chat because Q&A is going to be directly after that. And I'm going to treat you like I treat my in-person courses and be like, who doesn't like to get out of class early? Like, because if you don't have a lot of questions, then we're going to hop off. But if you do, then we're going to answer every single one because I'm down and I'm game for either one because I respect small business owners. And I know y'all are doing a huge, huge work out here to provide for your families and your communities. So drop those questions in the chat while you're hearing me talking about this last section of penalties if you have them. And I'm going to plug up my computer right here so I don't die on y'all while you're getting those questions together.
And good, I do see one already.
All right, let's bring this thing home. Success is not a linear thing. It's not a linear thing. We have roads that we travel to get to success. And so tax planning is definitely one of those avenues, right? A successful tax year takes energy. You know, a successful financial year in your business, I think one of the most challenging things that I did was actually move myself to the point to where I could become a full-time entrepreneur. Like I had myself on a 2-year succession plan to achieve it. And I had already been working on that financial freedom for 3 years before that. So you could literally say that it took me, and I've had my business for 12 years, but you can literally say it like it took me 5 years to do proper financial planning to get me to a place where I felt comfortable walking away from a 9 to 5, because I knew that the business would be self-sustaining, that I had a great financial plan, and not that I only had a great one in the moment, but I can follow it through for years to come. And it was a financial plan that I could scale upon. And now when we're talking about scaling our business, and coach you for just a minute because I can't get off of a live without doing one. So scaling does not just mean that we're able to sell more of our products. Scaling means that we're able to accept more customers. We can produce more product on demand without having hiccups in our business, and we can earn more money, and we could also grow in our help at the same time. So you typically growing your business is not a one-person thing. It typically takes a team. So whether you are expanding into a marketing team or virtual assistants or some other sort of outsourcing for a website, for anything else that you need to get done, for lead generation, whatever that is, it means that your business can do all of those things simultaneously. So until your business is really ready to open itself up to more customers because you can fulfill the requests in a timely manner and collect the payment for what you're doing in a timely manner and grow the business operations at the same time, that's a true scaling of a business. And if you can picture yourself doing that, you know that that's not going to be a very simple process and simple thing for you to do. Tax planning is only just a particular part of that, right? We're only looking at one little section of that when we're talking about tax planning, but it is very huge because the ripple effect that taxes have affect everything that goes on in your business with how you handle the funds and whether you're going to stay alive in this thing, like the BG said. So here are some audit triggers or some red flags that I want you to look for. And y'all let me know if you've learned something here tonight too. I don't see any questions other than Vanessa's. I'm gonna go back and answer Vanessa if we can talk about penalties, but let me know if this has been helpful to you, if you've learned anything. Let me know something. Drop something in the chat and talk to me. So trigger warning here. The IRS is triggered with red flags when you don't report all of your income. And there are ways for them to track this because income shows up in different places. So a lot of people are doing what they can to keep money, you know, kind of hush hush or under the table or whatever. We just have to be really careful with that because we don't always know on the giving or receiving end what's being reported. One of the major ways that we do know that is through 1099s that are reported, which usually catches a lot of entrepreneurs off guard. So money that's left your business, if it's going to an entity, more than $600 to the same entity in a year, you have to be careful with that because that's going to trigger the fact that maybe you either needed a 1099 for something, especially if you're not reporting it as the income that you're going to pay the tax deductions on. So just watch out for that. If you claim too many deductions compared to the income that you have. So say your business does bring in $10,000 this year, and you claim $25,000 in deductions, that's going to be kind of scary. For one, it's a signal that maybe you haven't done such a great job at handling the finances in your business and you may need to reconsider some things. Or it's going to be the fact that maybe you're lying about what's happening with deductions. So either way, it's going to trip the IRS to come and tap on your door electronically to say, hey, what's this? And why does it look this way? Large home office deductions. Be super careful with that. Make sure that you have the right square footage. If you've got like a 2,000 square foot home and you're claiming 1,600 square foot as the home office, you might want to watch out for that. So be careful in home office deductions. Excessive cash transactions. Be careful with this one. Let me just give you some notice just something that I learned when I closed out my 401k last year. I deposited that money into my business bank account, but I needed to make sure that I checked with my accountant and make sure that that was recognized as untaxable income, because it was income that had already been taxed. And so however I was going to add that to my business bank account, that's what I needed my accountant to report it for. That way it wouldn't show up at this excessive cash transaction that just landed in my account and just gave the IRS like this huge red flag of like, where did that come from all of a sudden? So be careful with that, excessive transactions. Again, use the software to help you track it. QuickBooks, FreshBooks, Wave, Gusto if you got employees, Gusto if you don't have employees, because you may like it too. Just check it out. But track those expenses automatically, and it's going to help keep them categorized for you. And keep those records for at least 3 years. I'll bump that to 5 and say personally, keep those records for at least 5 years. I think they can go back and ask you for at least 7 if you want to be specific, if you want to get technical about it. So 7 is good, but definitely keep 3 within reach. We go 7 years and we start getting papers scattered in old file cabinets and things like that. But keep 3 years directly within your fingertips reach. Just think about that. All right. Here's what you're going to do for growth and to help lower your tax bill legally. Here are those things I'm going to give you for growth and to help legally lower your tax bill. All right. So first, and it's not even on here, but make sure you research what tax credits you can claim. Track your expenses well. Max out your retirement contributions. Remember, I talked to you earlier about that SEP IRA, the Roth IRA, the solo 401k. Roth IRAs actually have a maturity date. So once a Roth matures, you can decide to take that money out and do something with it, or you can take it and roll it over and put it right back into the Roth. So that's a good idea for you. Write off those bad debts. It improves the relationship, gives you a chance to start fresh, only if this is something that you feel like you need to do. Now, if writing off bad debt is going to put your business in debt, then we don't do that. Right? All right. Hire your kids because you can pay them up to a max tax-free every year. I gave you the Augusta rule already, which says you can rent your home to your business up to 14 days a year. That is 100% deductible. So your business pays you and you can file it on your taxes. What? Yes, you get a double dip on that one. Legally, you get a double dip on that one. Just remember ordinary and necessary. But these are some great ways to lower your tax bill legally. And to prepare yourself for your tax bill legally, there's a total of 5 accounts that I recommend that my clients, my entrepreneurs that I'm working with, there's a total of 5 bank accounts that I will actually recommend you open for different reasons. And I will just give you 2 of them here tonight because I'm not going to overwhelm you. And that's not about this training. The first one, though, is for your operating expenses. Well, I'll give you 3. The first one is for your operating expenses. It's where all the activities happen. Augusta rule, no, it's not just for your primary residence only. That's a good question. It's for any residence that you own. So it doesn't have to be your primary residence. You just have to own it if you're going to claim it. So it's a good question, Lisa. Let me go back to Vanessa's while I'm answering questions. If you collect taxes in your own state, do you also have to charge for another state? You do not also have to charge for another state. For your own is better. It's very specific which businesses pay taxes in other states for certain services, but check that Nexus website to be sure. Vanessa, in your case, because I know your business, you will probably not have to worry about this at all. And I can have like a one-on-one chat with you where we can look it up again too. But that was a great questions from both of you ladies. Let's go back here. I have taxable money on a 1099-G from a USDA cost share. It's in my personal name. Where can I claim costs associated with startup expenses? GH is still employed. Yeah. Where or can I claim costs associated with startup expenses? You actually can from that. And you're going to claim, that's going to be a deduction. So you can claim that on a deduction. That's a good question, Lisa. Taxable money on it. Yeah. On a 1099-G from USDA cost share. Oh yeah. Yeah. If it's in your name, you definitely can. As far as it being a startup expense, where can I claim costs associated with startup expenses? You know what? I'm gonna take a picture of that because I'm going to message you about it. And what I'll have your email address because I think when you log into Google Meet, I think it captures your email address for who's watching. But if you want to, if you're comfortable with it, drop your email address in the chat for me and I will send it to you. I'll send you the answer to that question to make sure I tell you the right place to claim it. But that's a good one. All right. We finished up with Augusta rule there. I love that. I'm glad it was helpful, Vanessa. Awesome. All right. These are the things that we absolutely hate and we don't want to see them. We don't want to have to deal with the penalties. Negligence is what you have to be careful of. It's the main thing is what I see the most when it comes to the IRS being on a small business owner's heels. It is usually due to negligence. 99% of the time, I promise you. So only report the facts that you can prove. My dear CEOs, only report the facts that you can prove. Examples of negligence that I typically see is just not keeping the records to prove that you qualify for those deductions and credits that you're claiming. You gotta have the records to back it up. Not including income on the tax returns that was shown on some other information return. Because remember, I told you sometimes it shows up in different places and you wouldn't catch it or realize, not unless you're like the expert master tax person that will be able to see all of these things in your brain, almost like a beautiful mind. Not including that stuff like income reported on 1099s is where it happens a lot of time. Not checking the accuracy of a deduction or a credit. And if it seems like it's too good to be true, just remember that it usually is. But if you avoid those, at least those three things in negligence, I promise you that like those are the top three. So if you can keep those in check and only report the facts that you can prove, you'll be okay. What does the penalty look like? If you understate your tax liability by 5% of the tax required to be shown on your return, or $5,000, which is greater, the penalty is going to be 20% of the portion of the underpayment of taxes. So you're going to have to pay what you owe plus an additional 20% on the top of that. So it gets expensive, it gets pricey, and it does happen a lot. Now we have been through, there we go. I got you, Lisa. I've had to pay someone to build a greenhouse and buy several items, not selling yet. Oh yeah, just the build of the greenhouse. And what you've bought for the items, just all it takes is just receipts. You keep your receipts and those are going to be considered your startup costs. And you can claim those as deductions. And there's an area where you claim deductions on your tax forms. And I can send you that information too. And I also have it available on my website since tax season is coming up to help you guys out a lot. So these have been great questions tonight. You guys have had great interaction, great activity. I am Biz Coach C, and I will leave you with these gems. Just remember that you can claim both credits and deductions as long as they meet the necessary qualifications, but they don't fall under the same classification, which means they're going to be used for the same purpose. So you can claim both, just not for the same thing. In addition to exploring those tax credits federally on the IRS website that I gave you, don't forget to check with your state and local credits to make sure that you know what's available. There's definitely research and development credits available, as well as work opportunity tax credits, which are huge if you're helping employ people. And the last gem I'm going to give you is one of my favorite judicial websites. It's called Justtia Legal Resources. It is great about breaking down pass-through tax deduction and highlighting some other things that you may want to know about. So if you want more free trainings, more things available from Biz Coach C, follow me on major social media outlets. Go to my website, check the free trainings page. There's checklists there, there's templates there, there's PowerPoints there, there's videos there that you can have access to that's absolutely free for small business owners. If you want to be able to be eligible for that $1,000 micro grant at the end of the year, then attend 4 out of these 6 upcoming bi-monthly trainings. In person, if you're in North Carolina, I would highly encourage you to. If you're thinking about attending them virtually, then I will set that up so you can attend for them virtually because I have not arranged for that yet. But I would be happy to do that if you want to become eligible for that giveaway at the end of the year. It is going to go right now only to one one of the attendees that are coming that show up for the 4 out of 6. But honestly, if we get more donors, then we will definitely be giving away more than just that $1,000. So our donor list is stretching and it's getting to be where it's adding up. So we're very happy about that because it looks like we might be able to do more than one. But I'm happy to work with any of you for coaching services, with the filings, anything that you might need. I'll also do consultations with you, whether we're doing a free strategy session to do some brainstorming and just chat, or if we're doing a full out, help me form a strategic plan and put it in place, then there's consultations available for you as well. Group coaching programs are one of my favorite things because we take a group of like-minded entrepreneurs like yourself, my brilliant people, and we put you together in a group to either form your own nonprofit or your business over a span of 90 days, where we're really hacking out all of this startup structure, taxes, branding, marketing, business planning, until we actually get a business that is producing and getting results and on the mark within 90 days. So lots of options available if you want to work with me. And if you want to see more of my events, that's on my website too. Just go there and click on events. And I think I've got about 31 lined up so far this year. So keep in touch. Don't lose touch with me because I'm here to help. You guys, I really appreciate you watching. I cannot express how much I do. And thank you so much for joining tonight's call. I will be emailing you all the links. So I would love to have your feedback on how you feel like this went. And it will also help me improve. But you guys have a great night. And thank you for attending.